Of course, Amazon announced layoffs of 18,000 individuals. That's going to cost the company $640 million. Let's take a look at Amazon's labor problem in a little bit more detail to try and understand what's going on with its overinvestment in capacity. So what I have highlighted here is management's discussion from its latest investor update. And what they said here is that we entered the quarter with labor more appropriately matched to demand across our operations network compared to the fourth quarter of last year, allowing us to have the right labor in the right place at the right time to drive productivity gains. Now, I will highlight that it's not an easy task to manage the kind of surge that Amazon experienced during the pandemic. The company was already generating around $400 billion in sales, and then to get the kind of boost that it got during the pandemic at an already elevated level, that's an incredibly difficult task to manage. So, Amazon, being the customer centric company that it is, decided, okay, we're probably gonna get this wrong. We can't be precise in terms of investing in matching this customer demand. So if we're gonna get it wrong, let's get it wrong by over investing in the customer experience, right? Let's get it wrong by making sure that we've got enough fulfillment capacity. Let's get it wrong that we make sure that we fulfill our orders on time and maybe even ahead of time and surprise customers at how good we are at delivering the things they order when our competitors are going to have a lot of difficulty getting these things to their customers. So that's what Amazon did. It nearly doubled its fulfillment capacity that it had built up over the last 2 decades. It doubled it in like 2 years during the pandemic. And so it's understandable that now it's experiencing some of the after effects of that overinvestment. Now it's saying that we also saw continued efficiencies across our transportation network where process and tech improvements resulted in higher Amazon logistics productivity and improved line haul fill rates. So more of its fulfillment capacity is being used instead of being sitting idle and experiencing a cost. So as the company ramps up revenue, as it ramps up orders, it will continue to leverage all of these fixed costs. The trouble is that right now consumer spending is shifting away from online shopping. They're going back to some things that they missed from pre-pandemic times, like going out to bars and traveling. So that's pulling away, that's reducing some of the revenue growth that would happen at Amazon.com. That would help alleviate some of these headwinds from overinvestment. So it's going to take some time for these two things to happen, for sales to grow so that it can leverage those investments, and also some time to go by so that it can figure out how to optimize this network that it just invested in, right? It built up all of these warehouses, added some of this last mile delivery capabilities, and so now it needs to figure out, okay, how do we use this to best advantage us to reduce our cost, increase time to delivery, and all of that stuff. That's going to take time. That's not an easy thing to do, and that's what's hurting Amazon stock in the near term and Amazon profitability in the near term, because it's now starting to have to deal with all of these over investments while sales are slowing down. So as we considered the ongoing uncertainties of the macroeconomic environment, this led us to the difficult decision to eliminate just over 18,000 roles, primarily impacting our stores and device businesses as well as our human resource teams. As a result, we recorded estimated severance cost of $640 million. That's a lot of money to pay to fire employees, to get rid of employees. Now, I was a little disappointed in the magnitude of the job cuts, right? If you think about it, 18,000 is small compared to the 1.55 million employees that Amazon currently has as of the end of its most recent quarter. So 18,000 is a small drop in the bucket compared to that massive size of employee base. And also, I was a little bit disappointed in that these cuts were not in the warehouse and logistics and fulfillment areas. That's where I feel that they've got a lot of employees. That's where I feel like, yes, it may hurt its main competitive advantage, which is the fast and free delivery. But I feel that that might be a prudent decision to make in the near term to reduce these pullbacks in terms of operating income and operating profit. Um, and also, that would have been a less costly way for Amazon to reduce its employee headcount, right? Because in warehouse and logistics, more of its employees quit or move to other jobs. And in that way, Amazon does not need to pay for severance. It can just let these employees switch to other companies, let these employees quit without replacing them, and thereby reducing its headcount without incurring this large severance cost of $640 million to let go of 18,000 people. Now, I will say this is a much smaller severance cost compared to Google, which also reported job cuts, and their severance cost was in the billions to lay off a similar amount of employees. So, in comparison, it looks better in that regard, but still. A little bit disappointing in terms of the job cuts and the cost cuts overall from Amazon. I'm hoping to see more progress on this front over the next couple of quarters going forward. All right, so that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.